And good afternoon. My name is Matt Price. Randy is out today on this dreary Thursday afternoon. He's at a ministry conference with his wife, my mother. So here we are today, just me. Monthly market update, something we started earlier this year doing on a monthly basis. You know, it's funny. We can tell kind of what clients as a whole are thinking really just based off the questions that we're getting from a handful of clients. And what I mean by that is typically clients are asking the same good questions. What is also interesting is we know the interest level of information we're talking about based on how many clients attend the monthly market update and kind of read some of our material we're posting. November is shaped up to be a really good month for stocks and also bonds. So that is a good thing for most everyone on the call. And what that typically means is people care a little bit less. So I'm looking here at the numbers. We have maybe a little over a dozen. Typically, we have a couple dozen. So people are more interested when things are not going as well. So we actually like it when we have a little bit of a smaller crowd, which means things are going well. But a few of you that are not clients who we are, that Randy would try to tell you, he's my older brother, he's actually my father. 45 plus years, we follow a fiduciary standard. We think that's really important. We've created a niche where over 80+% of our clients are retired. And we think that's really important. In retirement, it's a completely different game than when you're saving money and still working or in what we call the accumulation phase. Retirement's just a completely different game. Randy has been awarded Barron's, Forbes, Financial Times, a number of awards. I really can't keep up with them. I was humbled to get an award from Forbes earlier this year. We both went to Wharton for our CIMA, our Certified Investment Management Analyst designation. We're both CFPs, Certified Financial Planners. We think education is really important. Steward partners, based off the biblical definition of stewardship, our custodian, just a fancy word for where our client assets are held. At Raymond James, we also have access to Pershing is another custodian, but all of our clients currently are with Raymond James. They've been a good partner with us over the years. So let's jump in. We have 5 or 6 slides put together, just kind of top of mind, what clients are asking, what we think might be important to take away from this call. Hopefully, no more than 10 minutes on this. We record this presentation. We'll send it to clients as well if you want to pass it along to a spouse, a friend, a neighbor. A little bit of a busy chart to start, but a question we have gotten with some regularity is what keeps you up at night? And our answer would be the federal deficit of our country. If you look here on the far right, the debt continues to increase, kind of where the dark blue goes to light blue. The dark blue is actual, the light blue is more forecast, but we're forecasting to have the debt really accelerate here over the next 5 to 10 years. And a big part of that is the middle box there, the surging net interest outlays. This is just the interest payments that the U.S. government is making on a regular and reoccurring basis with the money that they borrowed from other countries, from Americans, from, go down the list of whoever's buying U.S. treasuries. So we think one of the things that the Federal Reserve really missed was in 2020, if you remember, interest rates were at historic lows. The 10-year U.S. government bond got around to 0.5%. We talked about then, and now looking back, it makes more sense, but hindsight's always 2020. We were confused why they did not lock in more long-term debt. So when interest rates were really low, why didn't they lock in more 10-year, maybe even 30-year bonds? They kept most of their bonds short-term, which now has come back to bite them a little bit, just with short-term interest rates still being at rather high levels on a relative, but also an absolute basis. With that being said, we think bonds actually look attractive, and we haven't said that in a few years. I'll draw your attention to the middle chart here, the 10-year yield moved during a pause. And what that means is when the Federal Reserve raises interest rates, they typically have a pause, and that's kind of what we would think the period of which we are in currently. So Federal Reserve started raising interest rates last year. They raised interest rates up until a few months ago, and they haven't raised rates in the past few months. And the rhetoric that has been used has been, let's wait and see how the economy responds. So the 10-year U.S. government bond, which I have now mentioned a few times, that's kind of the main barometer for interest rates within our country and really around the globe, that peaked at a 5% number earlier this month. And so what this middle chart is showing us is when the Federal Reserve is pausing, typically on average, I'd say you have a 0.9% or a 90 basis point reduction in that 10-year U.S. government bond yield. So I said we peaked at 10. On average, what this is telling us is the 10-year U.S. government bond would come down to 4.1%. And today we're still a little bit above that. So we're of the opinion interest rates should move lower. And how much lower, no one knows for sure. We made a change in our taxable bond portfolio to add some more length or duration in anticipation that rates have moved lower. So that's what we've seen happen so far this month. We'll wait and see what happens next month and early next year. But turning to the stock market or the equity market, we thought it helpful to kind of come up with a list of the 5 reasons why we are still optimistic about stocks in the long run. We think the Federal Reserve is done raising short-term interest rates. There's another group of people that says they might have one more interest rate raise in there, and they might be right, but most everyone agrees that we're in the 8th or the 9th inning of raising interest rates. And so why that's important is once the Federal Reserve is done raising interest rates, typically it's a bit of a tailwind for stocks moving forward. So that's good for stock owners. Number 2, interest rates likely to move lower. Stocks are very sensitive to what interest rates are paying bondholders. And while that might sound a little bit technical, you're probably much more interested in stocks if your bonds are only yielding 1%. But if your bonds are yielding 7 or 8%, you might say, yeah, I'd be okay locking in some bond yields at 7, 8%. So the lower the interest rate, that kind of artificially props up the stock market. That we think is a tailwind if interest rates do move lower into the next year. A little bit of a contrarian for number 3. The general public as a whole, they're not necessarily super excited about the stock market, and typically the saying is the herd is wrong. So when everyone is optimistic, we get a little bit pessimistic. When people are pessimistic, we get a little bit optimistic. And right now the sentiment is that it's not good out there. December is typically a positive month for the stock market. You probably heard it referred to as the Santa Claus rally. And then earnings are, I'd say they're just now kind of coming out of the trepidation from COVID a few years ago. You had a huge move lower in 2020, even early 21 with earnings. And then you had this huge spike in earnings recovering from that COVID period. And we're just kind of starting to get our footing on what a quote unquote normal quarter over quarter change should look like with some of the companies and just the market as a whole. So in conclusion, we wanted to say just 10 things we were thankful for in lieu of eating too much turkey last week. And these are not necessarily in any particular order, but thus far, the economy has been really resilient. And we think that is something worthy of being thankful for. The U.S. still has a really low unemployment number, which is great. There's a good counter argument to that people have kind of stopped looking for jobs, which I think there's some credence to be given to that, but overall the numbers still look good. Inflation's cooling. This morning we just got another report that inflation is in the 3.5% range. While it's not to the Federal Reserve's target of 2 to 3%, they've made tremendous progress. When I look back to this time last year, inflation was, I call them the 6-7% range. So a lot of progress made in 2023 on reducing inflation, which is one of the reasons we've seen stock prices move higher. Already discussed number 4, the Federal Reserve near the end of its tightening cycle or increasing of the short-term interest rates. And a lot of clients are really happy seeing some higher yields on CDs, tax-free bonds, corporate bonds. So some higher yields to consider for the first time in a while. We've had some, like I said, good stock market performance just across the board this year. And I'll skip down to number 10. Always good to spend time with friends and family over the holidays. So if we don't talk to you before, Merry Christmas from the Price Group. Here we are, Tiffany, myself, Randy, Maddie, and Melissa. But if you do have any specific questions, our goal with this is to have it be just a 10-15 minute snip on a few things that we're seeing every month, but we're very happy to go into more detail on any of the slides we covered or answer any other additional questions. So once again, thank you for coming, and we'll look forward to catching up soon.